Hi everyone, this is Shreya, the podcast director for the Applied Finance Society. This episode was recorded on the 3rd of December 2024 and may not reflect current market conditions or events. For the latest updates, check out UniSuper's website for investment insights. Kicking off our first episode, we have Yilmaz, Chair of the Applied Finance Society, as our host. I'll hand it over to him now. Hope you all enjoy.
Hi everyone, and welcome to the first episode of the Macquarie University Applied Finance Society's podcast, FinTalk. My name is Yilmaz, and I'm the chairman of the Applied Finance Society. Today, we have a very special guest joining us. For the first episode of our Industry Insight series, we're thrilled to have John Pearce, the Chief Investment Officer of UniSuper, join us. With over 35 years of experience across Australia and Asia, John has held senior leadership roles in various large financial institutions, including Colonial First State and Ping An, China's second largest insurance company. Since joining UniSuper in 2009, he has been at the forefront of transforming the fund's investment strategies, helping grow UniSuper into one of Australia's leading superannuation funds, with almost $140 billion in management and nearly 650,000 members. Today, we'll be diving into John's career insights, learning from his personal experiences, and discussing what it takes to be a successful professional in finance. We'll also touch on his outlook on domestic market trends, economic policies, global economic conditions, as well as gaining his perspectives on ESG investing and the current state of the superannuation industry. So without further ado, welcome to FinTalk, John.
Great to be here, Ilmaz.
Thank you so much for obviously sparing the time to chat to us. So before we go into the more technical aspects, the more finance-centric aspects of our chat today, I'm wanting to quickly acknowledge the fact that you're actually an alumnus of Macquarie Uni, once studying a Master of Applied Finance. Can you tell us a little bit about your time studying at Macquarie?
Sure. Well, it was a long time ago. My recollection, it was actually we were just the second intake. Applied finance, and I'd been working for about 7 or 8 years at the time in financial markets, and what struck me was how relevant and practical the degree was. I was an economics undergraduate, and that had limited application in the job that I was doing. But here I was, and I'm learning about modern portfolio theory and option valuation techniques and equity valuation techniques, and I'm thinking, wow, this is fantastic. So to this day, I can still say it's one of the most practical learning experiences that I've had.
That's wonderful to hear. And look, sort of going a bit more forward now, from your experience, what are the 3 key bits of advice you'd give to those starting out or wanting to pursue a career within finance and, I guess, investments more specifically?
Sure, Yilmaz. And look, this is my view, and I'm not sure it'd be much different for whether it's finance or anything. What do I like to see in young people? The first thing is, I like to see a general curiosity. And it's not just about the subject matter at hand. It's just curiosity about how the world works. I want to see a passion, with investments, a passion for the subject matter that extends beyond just passing exams. We got a lot of bright people in this country with great institutions, etc. But it's not just, don't demonstrate just by, oh, look, I've got a high distinction or a distinction, etc. It's say, look, I'm interested in this subject matter. This is what I do in my, like yourself, in my spare time, because I'm interested. The other thing is, we want to demonstrate that you're willing, this sounds like a bit of a cliche, but whatever it takes to advance. And that means doing the job that's put in front of you rather than getting too far ahead of yourself and saying, hey, I want to be this in 3 years' time or that in 3 years' time. It's, look, hey, I've got this job, and if I do the best job possible with the role that I've been given, opportunities might develop over in the future.
Yeah, I definitely agree with that. I think a lot of us probably get a bit of ahead of ourselves sometimes. We should just focus on the task at hand. I guess now more to like a work-life balance question for you. So, many students at uni struggle to maintain a work-life balance with several commitments. They might be working and studying at the same time. How do you manage your work-life balance, and what advice would you give to students or young professionals in maintaining this balance?
Might be the wrong person to ask here. Look, what's my observation about really successful people? Right? And when I talk about really successful, I'm talking about the elites, who gets to the top of their game, and whether it's in business or in sport or even if we're talking about in their personal lives, etc. They have to make sacrifices. Show me someone that has been really successful at something, and I will show you someone that's had to make sacrifices. So I think this whole work-life balance, particularly if you're a young person and you haven't got family commitments, etc. My view is that you should be pretty focused, and you should be prepared to accept some compromises on the fun parts of life if you really want to be at the top of your game.
No, that's fair enough. There are a lot of distractions in life sometimes, but yeah, staying focused is pretty important. And look, just finally, before we get into the more finance-centric topics that we're going to discuss today, as the CIO of UniSuper, what does a typical day look like for you, and how do you prioritise your tasks given the scale of UniSuper's operations?
One of the beauties of my job is I actually don't have a typical day. Look, obviously, there are some formal aspects of my job that are set in stone. We can't avoid. There are very senior level meetings, whether they're board or investment committee or our executive meetings, which they're part of the diary, and we've got to work around those. They're not movable. When it comes into prioritisation, what I call the more discretionary parts of my role, the first priority will always be to anything that is investment related, and as in anything that I know will potentially lead to a real investment decision. That comes top of the tree because we know that capital doesn't sleep, right? And markets, every day you can wake up and something has potentially happened, right, that you didn't anticipate. And we just have to move things to the side. When Japan, the Japanese stock market was down 20%, there was a whole bunch of meetings I had scheduled for that day that I said, look, I'm not going to make because we are now going to be, it's game on. We've got to be very active. So, but then we've got other balancing things. I've got internal and external stakeholders, and I'll make a call depending on what I think the best use of my time on any given day or week.
Thank you so much for that, John. I'm sure a lot of us are going to get a lot of value out of your perspectives there. Now, wanting to move more into the finance-centric topics today, and I guess we'll start with the domestic market. Seems like a great place to start. And just to give a bit of context to our listeners, at the time of recording, in the financial year so far, the Australian market has been ripping, I think it's fair to say, and the ASX 200 is edging closer to 8,500 points. With this sort of market environment currently, how do you foresee Australian markets performing over the next 12 months?
Firstly, we can't avoid the fact that the US market will still lead the way. But if I look at the domestic market, the key is inflation. Right? And if inflation starts ticking up again, I think this rally will absolutely fizzle out. But the opposite also applies. If we can actually get inflation back below 3%, we can definitely hold the gains.
Okay, John, now I'm wanting to move into the global economy now and talk about some global economic conditions. Now, I'm going to address the elephant in the room right away and, acknowledge the fact that Donald Trump has recently won the US election in a red sweep. And just for our listeners who might not be familiar with the jargon, this means that a Republican nominee won the presidency and the Republicans won a majority in both chambers of Congress, with those being the House of Representatives and the Senate. Now, Trump winning in this fashion means that it's probably going to be easier for him to pass his legislative agenda due to limited opposition from Democrats, who are now in the minority in both chambers of Congress. Now, during his campaign, Trump proposed enacting tariffs on goods made in foreign countries, potentially adding costs to imported products. China is especially targeted by the proposal, where he said he would impose tariffs as high as 60% on goods made there. And he's also proposed a tariff of between 10 and 20% on goods made in other countries as well. So with all that preamble out the way, John, what specific data or trends do you consider to be the most critical for guiding your investment approach in the global markets, first and foremost?
Yeah, we might get on to Trump in a minute. But if I look at the overarching global trends, three key trends. Firstly, the tech revolution continues. And it seems to me that just when it looked like it was fizzling out, along comes AI. You look at something like ChatGPT, a stat that always blows me away. It took 16 years for the smartphone to reach 100 million users. Wow, yeah. It took 2 months for ChatGPT.
That's crazy.
That's incredible. Yeah. So, the tech revolution, decarbonisation, a massive trend that you just have to take into account. And the third one is deglobalisation. This is links into your Trump, talking about Trump. And we're seeing a potential, situation where we've got this industrial policy. Governments are talking about industrial policy. It really becomes more of a nationalist, protectionist policy where everyone's saying, it's made in America, made in China, made in Europe, we've got it made in Australia, etc. This is becoming a trend, and it's not a very healthy trend. And I think Trump is actually going to exacerbate this trend. He's very much, it's all about America, making America great again, and that is bringing everything back on shore, etc. Now let's see how much this plays out. In terms of the so-called Trump trade, we can see that the market's obviously getting pretty excited because Trump stands for lower corporate taxes and deregulation, etc. These things should be good for corporate America. But if he starts a fully fledged trade war and he goes through with 60% tariffs on China, 10% tariffs on the rest of the world, etc., that will be bad for business, okay? And I'd imagine the market would give back a lot of its gains.
Yeah, and let's actually chat about Trump now. So how do you expect Donald Trump's win to affect Australian markets and UniSuper's investments?
Yeah, look, I don't think we would escape that. Clearly, Australia is very dependent on trade with China. China is our biggest trading partner by a long way. So to the extent that Trump has China and we get caught in the vortex, that's saying, when the elephants fight, the ants get trampled. Well, we're one of the ants. So I really do hope that we stay out of the fray. I think the government that we have at the moment, one of the things that they have been good at doing is managing the relationships with China. So let's hope that continues.
And I guess moving forward a little bit, sort of talking more about risks. Now, what are the most prominent risks that you assess when you develop UniSuper's investment strategy?
I think inflation is the biggest risk, and I think the governments are the key drivers of inflation. I think governments risk there in terms of their spending, in terms of their protectionist policies, in terms of tightening up labour markets. So I think that's the biggest risk. The geopolitical, I'm not as concerned.
And why is that?
And it's because, well, if you look at, we've seen a flare-up in geopolitical tensions. We've seen what's happened in Ukraine, we've seen what's happened in the Middle East, etc. What's happened to commodity prices? They haven't spiked. We had a little spike in energy, etc. There's more oil swashing around the world than ever. There's gas. Russia's going to export gas again to Europe. So it's not having a sustained impact. If indeed, and God forbid, China invades Taiwan, all bets are off. My view will completely change, all right? But that to me would be, the nuclear sort of outcome. So let's hope sanity prevails there. And I'm not as concerned about geopolitical risks.
Okay, John, now just finally for the global economic conditions, what's your take on investing in emerging markets and how does UniSuper assess potential risks and rewards associated with investing in developing economies such as India and China?
Yeah, look, firstly, generally, investing in emerging markets has been a terribly disappointing experience for most investors. And if I look at one overarching reason for this, there'd be there's many idiosyncratic reasons, but one overarching reason is that companies in emerging markets have typically not been capital friendly, and they have not been able to transform or capitalise on the growth in their domestic economies and convert that into returns to shareholders. And frankly, I don't see that that's going to change anytime soon. We have had a bit of success in India, so as I said, there are some exceptions. Going forward, we will stay out of Latin America. We'll stay out of Eastern Europe. We definitely won't go to Africa. We'll have an index weight in China in Asia with a heavy focus on India. We're still tossing up as to whether China is frankly investable or totally uninvestable. So it's index weight at best. It'll have its occasional spurts, but until they can demonstrate that they become far more shareholder friendly, it's one to avoid in terms of long-term investing.
All right, John. So I just wanted to quickly zoom in on the tech sector a little bit. I know earlier you mentioned the fact that tech is, ripping and is, really the reason why the US market is performing so well. So this year, the Magnificent Seven once again proved that they are indeed magnificent, with Nvidia skyrocketing nearly 200% and Meta returning an incredible 76% and also Tesla climbing an impressive 44%, all fueled by innovation and buzz around AI. So I just wanted to ask you, with all this buzz and excitement around tech and this optimism, how do you balance that with the risk of potential overvaluation in the sector?
Yeah, once again, some fun facts to get the conversation started. Nvidia, obviously, it's the poster child of the AI boom. So it just announced its quarterly results, which brings annual sort of profit up to around $76 billion US. About 4 years ago, that was $4 billion US.
Yeah.
So, we're talking about, serious growth here.
Yeah.
Market cap of NVIDIA, over the last 12 months, actually, its growth in its market cap is bigger than the entire value of the Australian stock market. So it's a really serious company. And everyone talks about, yes, look, we've got this concentration, we've got this overvaluation, but what have we found with tech? That they tend to grow into their valuations, right? So when Apple was trading at $1 trillion market cap, everyone's saying, oh, this is overvalued. Then it was $2 trillion, then it was $3 trillion. Because they, as I said, they're growing fast, growing into their valuations, and the growth prospects still seem to be strong because they're generating a lot of cash, right? And they keep reinvesting to fortify their positions in the market. So we can't avoid tech. So even when we think that they could be overvalued, the question is, do you sell, hope for 10, 20% retracement and get back in? Well, that's a tricky thing to do. It's a tough to get that timing right. So we're overweight tech and we'll stay overweight tech. One of the things that we have avoided and will continue to screen out is what we call long duration tech, where you've got a lot of the smaller ones that where there's a long sort of path to generating cash. If you avoid them, you're likely to avoid the worst impacts of a market correction.
So thank you so much for that, John. Now, I'm wanting to move into sustainable and responsible investing. And I guess I'll preface this section just for our listeners who might not be from a finance background or might not be familiar with this area. So ESG, if you've ever heard of ESG investing, ESG stands for environmental, social and governance. And it's a way to evaluate how companies consider things like sustainability, social responsibility and ethical management in their decisions. So companies will often use what are known as screens. So you'll have positive screens and negative screens. So for example, for a negative screen, it might exclude companies involved in harmful industries like tobacco, fossil fuels or armaments from investment portfolios, and vice versa. A positive screen is including companies that actively promote sustainability, such as renewable energy providers or those with strong diversity policies, for example. So, John, a question to you now. Can you explain UniSuper's ESG process, using positive and negative screens and how these criteria guide your investment decisions?
And look, we can get hung up on labels, and for different funds they apply labels differently. So maybe just in terms of UniSuper, the way we think about this, the term responsible investing, we actually don't see that as a product-specific label. We actually think that's more of a philosophy, and it comes back to our underlying principle is that we see superannuation as being people's life savings, right? And responsible investing means treating superannuation as life savings and then always operating in members' best financial interests. Right. And best financial interest then leads to, you're looking for companies that are going to generate sustainable profits, sustainable dividends, etc. So that's what we call responsible investing, and then ESG becomes a screen there over your whole portfolio. Right? We're looking to make sure we're looking for red flags. If company stewards, right, are not taking ESG considerations into account, they're probably doing a lot of other silly things in their business as well. So that becomes an overarching sort of screen for negatives in the company. In terms of sustainable, yes, we do have we have a sustainable balanced option and we have a sustainable high growth option, and they screen at exactly the companies that you referred to, those involved in alcohol, gaming, armaments, etc. On the positive screen, we have global environmental opportunities, and that's looking for companies that are leveraged to the environmental themes such as EVs, renewable energy, batteries, etc.
Cool. And so I know you spoke about it just a little bit there, but just wanted to zoom more into this. Why do you think ESG investing is gaining popularity, and how do you see this trend evolving in the next few years? Yeah,
look, it's interesting. In the US, it's might even be going backwards because we've got now a lot of the red states actually looking at clamping down on ESG investing. I think, once again, responsible people, particularly Australian superannuants, they want to see their money invested responsibly. So I don't think that's moving away. The label ESG, it depends on how it's applied. What you'll find with a lot of ESG-themed funds, that they are typically long tech, short energy, if you think about the screening process. Yeah. And to the extent that tech revolution continues, right, and we're seeing these those sort of options outperforming their standard options that include energy, which has been underperforming, you could still see more money flowing to the sector. Then, of course, you get the problems of overvaluation and you get corrections. Over the very long term, we expect that these options will perform broadly similar to the more standard options. So I think flows over the long term will probably even out.
All right, John, now just to finish off our discussion today, I was wanting to ask you a little bit about the superannuation industry. Obviously, I'd be remiss to come and talk to you and I don't ask you anything about the superannuation industry. So just to give a bit of context as well here, Australia's superannuation industry is set for significant growth in the coming decades. Currently, the superannuation balances in Australia are currently sitting at nearly $4 trillion. By 2040, total superannuation balances are projected to grow to $9 trillion, more than doubling in the next 15 years. So, John, what trends in the super industry are you monitoring currently and how will these shape the future landscape of investments at UniSuper?
Sure, let me point to a few. Well, the biggest trend is consolidation of the industry, and you're going to see the big are going to get even bigger. And what does that mean? What are some of the implications of that? I think you're going to find that big super is going to be far more active in terms of corporate Australia, and maybe that might take the form of a far more public activism. We've always been, very engaged in terms of our voting, etc. But you're probably going to have super having a bigger say in corporate activity and corporate Australia. I think you're going to see what's the biggest benefit of being really large is our ability to participate in direct investing, right? Rather than in public markets. So I think you're going to see a lot more of that with big super. There's a lot more talk about retirement. So we're seeing ageing demographics. I call it the pig and the python. You're seeing your members coming through the system and they're becoming net withdrawers rather than contributors. Sure. And that could change in terms of our focus. What I'd like to see, but I'm not seeing it at the moment, is scale also results in lower costs. Sure. Right? And this is where I think we've got to be really careful. We've got a lot of commentators talking about expanding product to suit retirees and expanding services, etc. That's anathema to cost reduction. The costs in this industry are too high, so we need regulators and politicians and other key influencers to work out better ways to reduce costs rather than to proliferate products and unnecessary services.
Yeah, and I guess for my next question, obviously doing a bit of research for this podcast, I noticed that when you came to UniSuper in 2009, you decided to bring the bulk of your funds in-house, up to 70%, I think at this point, in fact. So can I ask, what was the decision-making process? What was the reason behind moving majority of your funds in-house?
Well, it was a pretty easy decision for me to make because I had come from that sort of background, right? So I was previously running Colonial First State, so we were obviously an asset manager, so it was pretty much trying to get that model working at UniSuper. Unlike a lot of my peers at the time in the industry, and the industry has changed a lot since then, I was far more comfortable with the risks involved. I knew that if we got the right people, put in the right processes, had the right systems, etc., we could actually reduce risk, and we've proven that to date. So I was very comfortable from the outset. Clearly, the prospect of tailoring strategies to suit our product suite, the prospect of reducing costs was very compelling, and also gave us much more influence on ESG. We're now meeting directly with the corporate captains of Australia rather than doing it via third parties. So all these things led to what to me was a fairly straightforward decision. Very importantly, though, I had very strong support from my board and investment committee. It was all systems go from the outset.
Yeah, that's awesome. And, I guess just closing out now, obviously listeners will know one of the Applied Finance Society's 3 objectives is to improve financial literacy, and I hope that the listeners have found this chat interesting and insightful. I know that I have. But just to end off, the final question that I have for you today, John, is, what is something that you wish you knew about super at our age? What would you do differently if you knew what you know now?
If I was a young guy, young girl starting out, I'd go all out growth. Sure. That's one thing you would do for sure. Okay, and simple to say, but you've got so much time, and if you look at any long-term graph of stock markets or any sort of growth asset, what do? They go from the bottom left-hand corner to the top right-hand corner, and that's because people want to grow, and people want to grow, so economies grow, and economies grow, and corporate profits grow, and that ultimately translates into higher asset values. So, to me, a young person should be going all-out growth. History belongs to the optimist.
All right, well, John, thank you so much for your time today. Really appreciate the time that you've spent with us. I know that our members will really appreciate you being here to chat to us. Do you have any closing remarks for us today?
Just stay positive and be useful.
Very straightforward. Thank you so much, John. And just to our listeners, thank you so much for taking the time to listen. I really appreciate your support, and we look forward to seeing you again listening to FinTalk next year. Thank you very much.
The podcast was recorded on the 3rd of December 2024 and may not reflect markets and events at the time of publication. For a more recent update on investment markets, please refer to UniSuper's monthly investment markets podcasts available on their website and to UniSuper's Chief Investment Officer John Pearce's latest investment update at unisuper.com.au/investments. UniSuper notes that sustainable and environmental investing means different things to different people. Visit UniSuper's website to find out what sustainable and environmental investing means to them and what their investment options invest in. The information is of a general nature and doesn't consider your personal circumstances. Comments on companies aren't intended as recommendations of those companies for inclusion in personal portfolios. Before making decisions, consider whether the information is appropriate for your circumstances and seek financial advice if you need to. Consider UniSuper Limited's PDS and TMD on its website and your circumstances before making decisions.